Welcome to the Spokesman Speaks, a podcast for farmers and ag professionals by the Iowa Farm Bureau, bringing you the news, experts, and educational insights that matter most. Now, here's your host.
Welcome to our December 18th edition of the Spokesman Speaks podcast. I'm Andrew Wheeler, and today's episode features insightful discussions with renowned ag economist David Widmar of Agricultural Economic Insights and esteemed livestock attorney Eldon McAfee. Let's get started with David Widmar, who led an in-depth educational seminar for farmers at Iowa Farm Bureau's annual meeting earlier this month. David presented 4 key economic trends for farmers to keep their eyes on, and he shared strategies to help farmers navigate the economic uncertainty they face. Afterwards, he caught up with Spokesman reporter Bob Beyond.
Good morning, Dave. Before we get into what we may see going forward, why don't you just share a little bit about yourself?
I'm an agricultural economist by training. Grew up on a family farm in southern Kansas and currently live in West Lafayette, Indiana. Started Agricultural Economic Insights back in 2014. Previously, I worked at Purdue University, but my entire career has been trying to help producers and those who work with producers understand the key issues in the farm economy and make better decisions in light of that. There's always a lot of noise and a lot of turbulence and a lot of uncertainty in agriculture. But how can we use data and trends and ideas, first level thinking, and sometimes even history to help us make better decisions at the farm level?
So today you shared 4 key trends, and I thought we might take each of those one at a time. The first was farm income and the return to normal. Could you explain that?
Yeah, so we have had 3 really phenomenal years in U.S. agriculture from 21 to 2023. A lot of folks have focused on that year-over-year decline between 22 and 2023, but these last 3 years have been significant in a couple ways. First, they're historically high. They're in some of the top 10 departures from the long-run average. The second one is when you look at the 3 years as an average, it's the best 3-year stretch we've had since the 1940s. And lastly, 2022 was the best single year when we adjust for inflation going back to 1929. And so there is going to be probably several years of declines in net farm income as we leave these really good periods and maybe revert back to something that's more closer to normal. The second thing that's important to keep in mind is the base rate. What does that mean? Well, what does the history normally look like when it comes to farm income? And again, this is income across all farms in the U.S. farm economy. And what our data and what the chart I showed producers today shows is that we spend a lot of time in what we call the steady era in agriculture. And in inflation-adjusted dollars, it's about $100 billion here in 2023. But we spend periods like the 1950s, the 1960s, the 1990s, and most of the 2000s at a pretty flat, steady-state era. And so it's these departures way above the trend line or way above that long-run average that captures our attention. So the 1940s and the 1950s are an era with farm income booms, the 1970s, the 2011, 12, 13, and of course the last 3 years.
The second kind of centers on trade tensions, the role of China and where the U.S. fits in that whole discussion. What's the future look like for trade?
Well, one of the key stories we learned from history is that during the 1970s, we had this explosion in net farm income during the early 1970s when the Russians, quote unquote, stole all the U.S. grain, the great Russian grain robbery, so to speak. And by the time we ended that decade, we had an embargo in place where U.S. grain wasn't allowed to be shipped to the USSR after their invasion of Afghanistan. And so we have this lesson of big trade partners becoming foes and the demand booms and busts that come from that. And what's important to keep in mind is we've been enjoying 20 years of China buying a lot of agricultural goods and services from the U.S., but also around the world. But one of the things we've seen in the last 5 years is the tension really coming to the front and center. And unfortunately, when it comes to a U.S. versus China trade tension, agriculture is one of the Achilles heels for U.S. and especially our ag exports. So on the positive side, the U.S. exported a record amount of ag goods to China in 2022. It was also really strong in 2021. It's going to be strong in 2023. But the tension is still there. I talked about Panda diplomacy and how we need to keep an eye on these trade relations. During the trade war, I was reminding producers about how the U.S. has pandas and the zoos in the U.S. have pandas due to China's diplomacy and sharing pandas with allies or friends that they want to cultivate relationships with. But in the last few years, we've seen the panda diplomacy starting to wane, and 3 of the 4 U.S. zoos have lost their pandas. Now, in the last few weeks, President Biden and Premier Xi met in San Francisco, and there seems to be maybe a return to panda diplomacy. We'll see how that shakes out. But the reality is we've been on a tough footing with China. The trade war was sort of the first clear evidence of that, and that has continued into the Biden administration, and that has continued despite China buying records amount of U.S. goods, agricultural goods and services.
So then there's the macroeconomic challenges. What do you think we'll see with commodity prices, inflation, and interest rates?
So one of the challenges we have from the 1980s that I talked about is how $3 corn in the early 1970s was this high watermark for the good times in U.S. agriculture. Corn prices throughout the 60s were around $1 a bushel. And then in the 70s, we had $3 corn again in late 1978 and again in 1982 and in 1983. But inflation really cut into that purchasing power of that $3. And so that $3 corn wasn't enough to prevent what ended up being the 1980s farm financial crisis. So what's the reminder there is that when we have inflation that lasted for more than a decade at thresholds that were at 7.5%, so higher than what we've seen in recent memory, even despite our inflation runs, that had a big impact on the farm economy. And of course, the cure for high inflation is higher interest rates. And we lived through a spell of that. And it's important that producers kind of keep an eye on this. If inflation in the U.S. here currently gets underway and we get that behind us, gets back to the Fed's target of 2% and stays there, some of that interest rate pressure comes off the table. If we see inflation sticking around, maybe rearing its ugly head, so to speak, again, the upward pressure on interest rates is going to continue as the Fed has to keep battling that in the weeks and months ahead. I don't know what's going to happen here, but I think those are two paths that producers can keep in the back of their minds as they think about where interest rates might be headed and the impacts for their operation in 2024 and beyond.
On that note, what do you think on commodity prices? What are your thoughts on where those might be headed? They've obviously come down in the last year or so. Thoughts on that?
One of the questions we keep asking producers is where do they think corn prices will be? What will be a normal corn price in 3 to 5 years? And I don't really have a specific opinion, but it's interesting to have them give that feedback. And $5 is a price that a lot of producers have been sort of hanging their hat on. It's near and dear to where we are maybe today, maybe higher than the cash bids that we're getting today, but maybe in line with what we can see in our budgets for 2024. What's important for producers to remember is they're price takers. There's not a lot that producers can do in the long run to influence where corn prices are maybe 3, 4, 5 years from now. What they can do is they can put in protocols and a plan together on their operation that allows them to respond to wherever those commodity prices eventualize. And so how do they make sure that their costs of production allows them to generate positive cash flows and allows them to create profitability if corn's at $5.50 or at $4.50?
So the fourth key trend you talked about were farmland values. We've seen a boom in recent years. What does history show us that could happen, and what will be the challenges for the farmland market in the future?
Well, there are two drivers that are fundamental to understanding farm real estate values. First one is income. So what can we anticipate the annual income to be from farming that, or maybe owning it and renting it out to producers? A lot of time, the cash rental rate's a great proxy for thinking about the returns to the land itself. And as we talked about at the beginning of this conversation, we're at record high farm income levels, and commodity prices are coming off that peak that we saw just a few months or years ago. And so maybe there's going to be some downward pressure on cash rental rates. We saw some of this back in 2014, 15, and 16, and that pushed farmland values lower. Again, it's just recognizing where we are in the cycle and how that's going to impact maybe where I'm not saying it's going to happen, but we're just recognizing that we're at these really highs. We came off them a little bit. It could impact cash rental rates a little bit. The second piece, I think, is a little more fundamental, a little more less intuitive, but also perhaps more consequential, are expectations about capitalization rates. And what are capitalization rates? That's that relationship between how much income does this farm generate on an annual basis, and then what does that mean I'm willing to pay for the valuation of that asset? So it's a relationship between the rents or the income and the asset values. Interest rates throughout the entire farm economy and the macro economy have been trending higher. So what kind of return will producers be wanting for that farmland that they're buying in 2023 or into 2024? Are they still going to accept these historic low cap rates, or are they going to start to move the needle and accept a higher rate, in line with other things throughout the economy?
Well, let's pivot a little bit towards the strategies you shared with us about what a farmer can employ on the farm. Number one was practice running counter-cyclical to the crowd. What do you mean by that?
Yeah, it's just recognizing that sometimes there are just these ideas that get pervasive throughout the crowd, and they start to create their own challenges or their own waves and their own disruptions. And they might not be grounded in logic, or they might not line up with your own business needs. So one of the trends that we see throughout the farm economy is this swing in sentiment, and a lot of times from how are we going to feed the world, X billion people by 20 such and such. And that's a really important question, it's one not to dismiss, but generally those conversations are being had when commodity prices are really high. And it's worth recognizing that, are we increasing agricultural production when that happens? And, we don't want to build a business saying that like, oh, because we're worried about feeding the world's population by 2050, that commodity prices are going to be high every single year between now and 2050. There are going to be ups and downs. And so when others are fearful, we should maybe be greedy. When others are greedy, we should maybe be fearful. The other one to keep in mind is, farmland values have been really strong the last few years. And you hear a lot of folks saying like, well, farmland values have been strong. They'll continue to be strong because farmland's a good investment. So I'm just going to bid whatever it takes to buy the farm. And the idea of being counter-complacent or counter-cyclical is to just always be thinking about, okay, what are the assumptions that others are using? Do those line up with my assumptions? And how might my assumptions or the crowd's assumptions be wrong? But think back to the 1980s and how pessimistic folks were about buying farmland after it lost more than 50% of its valuations from the start of the decade to the end of the decade. And that might be another example of, oh, it's probably a good time to be buying farmland because everyone's really pessimistic. Again, the counterexample to that is the late 1970s. Everybody was buying farmland, and it was what turned out to be the peak. So just recognize that sometimes the crowd is wrong. Actually, often the crowd is wrong.
So then there's balancing data and decision making. What does that mean?
One of the things that we learn when we think about crises throughout history is there's always a crisis of data. So in the 1980s, producers didn't know how low farmland values would go. Bankers were trying to figure out how many of their assets were underwater because of the fall in incomes or the fall in asset values. When we think about the housing crisis in more recent years, in 2008, 2009, there was a question about how many of these loans were subprime mortgage and how many of them were underwater and how many of these toxic assets did the banks have and how many banks were in trouble. And so this is an example of we have to have processes that allow us to have really good insights onto our business. And then we also have to be able to flip the switch and recognize at some point in my career, there will be a challenge, a crisis where I don't have enough data to answer the question. So we can't get paralyzed in that transition. We have to recognize it and still make good decisions despite the shortcomings of data.
It's always good advice to plan for extreme events. How best should a farmer approach this?
Well, that's a great question, and it's not one that I necessarily have an answer to. But I think what we know from human nature is that if you were to ask producers, what's the range of corn prices going to be traded? So let's say the December 2024 corn contract, what's the range that corn contract is going to trade in? And if we wrap up the year, a year from now, we actually plot, most of us are going to have too narrow of a band. And that is just consistent human nature. And what that tells us is that humans are pretty optimistic. We don't think there's about as much risk in the system as there really truly is. And so what does that mean for producers is we need to first think about the range of possible outcomes and then what we think they are, and then challenge ourselves to push it even further. And then adapt our business model, adapt our plans to reflect that uncertainty and those ranges of possible outcomes. Working capital is a really important tool that helps producers weather the downsides and the bad years that are inevitable in agriculture. And one of the issues that producers have been wrestling with the last few years is, do we have enough working capital? Are we building sufficient working capital? Especially given the conversation we had earlier, when costs of production are high, commodity prices have been high, but they're starting to come down. Do we have enough working capital to weather that next margin squeeze?
So another strategy that you mentioned was insulate your thinking. We're all fed that daily amount, and I think you called it a torrential amount of information. It's right at our fingertips. How should we best navigate uncertainty, all that information, and the chaos that could ensue?
Yeah, we don't have to look for the news. The news tends to find us in one way, shape, or form. And I think it's always important to step back and do an inventory and think about, what's the quality of the content that I'm consuming? Is it helping my business make better decisions? And ultimately, a lot of the times we might find out that we could be doom scrolling on our favorite media site or social media site and be getting a lot of dopamine and a lot of feedback from that. But ultimately, is it helping us make better decisions? And the answer, unfortunately, in a lot of cases is it might not be. And so we all have to do this on our own self. We have to do an inventory and recognizing, what am I consuming and how is it helping me down the road? So sometimes I might be picking up a book or listening to a podcast or reading a newspaper or maybe reading a thought piece on an issue that we're wanting to explore more. Maybe we want to learn more about working capital, so we pick up a farm management textbook or read some extension documentations. The key idea is, be a consumer of content and ideas. Don't be just reacting to whatever gets sent your way.
So let's talk a little bit about history. You mentioned that in your presentation a little bit today, and the role history is playing. If we look back, are we seeing any repeats? Something from the 70s, 80s, 90s, and beyond, now as we go into the 2020s and above, any repeats that we can look at, say, hey, maybe this could happen in the future?
Well, I think there's a lot of insights but shortcomings that can come from that type of analysis. So the insights are, there is a lot of uncertainty in the U.S. economy, the global economy, but also global tensions. And one of the eras that come to our mind when we think about inflation and rising interest rates and global uncertainty is the 1970s, of course. But it's just as valuable to hit the pause button and say, well, how are today's conditions different than 1970s? That's where that quote, history doesn't repeat itself, but it often rhymes, comes in. So we would never expect a complete repeat, but there are these cycles and there's these things that unfold and kind of surprising correlation from time to time, and kind of be kind of shocking to look back through history and realize how close it feels like it's repeating itself. But I think one of the key points here that is new territory for a lot of producers that bears some thought and some challenging to the assumptions and the business models is a rising interest rate environment. Interest rates have generally trended lower since 1983. And in the last decade, they've been historically low and very stable. And so we've seen a rising interest rate environment, and there's a whole lot of uncertainty about where interest rates will be 12, 24, 36 months from now. And producers have not been in that business environment for several years, if ever. And I think that's the piece that we need to be upping our game on.
Say they stay high. What should farmers be doing? What's that going to mean for the ag economy if they stay high?
Well, interest rates impact everything in the economic universe. That's an idea that Warren Buffett has been sharing for a long time. And so I like to turn it around and just challenge producers, how won't it change the way you're running your business? I think the first piece is it going to change the quantities and the ways that we use debt? So when you think about Econ 101, was the price of something goes down, we should use different quantities of that. So maybe we're going to use different quantities of debt. The data says that might not, be as easy as I simplified in that example. But the idea here is producers saying, okay, how am I going to use debt differently, for example? We've seen the inverted yield curve over the last few years. That was telling producers short-term rates, like an operating line of credit, are really high, but farmland rates are maybe cheaper. So that's a way that we can rebalance the types of debt that we are using. Another example here is maybe we're looking at investments. So let's say hypothetically we have $100,000 that in our bank that we want to deploy, and there's this technology that we can buy that creates an ROI of 4%. Are we going to pursue that opportunity? Well, if the bank's going to pay us on a CD 4.5% or 5%, no management effort, all of a sudden the hurdle, the investment hurdle for the things that we want to pursue gets brought up. So maybe ideas that were worthwhile pursuing at a near zero interest rate environment don't make as much sense today. And so that could be another shift that producers are saying, that these ideas and technologies and management pursuits that made sense a few years ago just aren't in the wheelhouse today.
Well, let's kind of wrap up with something in a nutshell here for the Iowa farmer. What does the Iowa farmer have to look for and face in the short term and the long term?
In the short term, we're always going to be thinking about the crop budgets and how are you going to market our crop to get a profit here to wrap up 2023 and prepare and plan for 2024. So in the short term, we're still going to be dealing with uncertainty around interest rates and the global economy and crop prices being a little lower than they were a year ago and cost of production being slightly improved. So producers are going to be focused on that blocking and tackling. I'm optimistic about agriculture in the long term, and producers need to step back and say, what are the changes that we want to make today that are going to position our business and our families' livelihoods for the positive 3, 4, 5 years from now? And the idea of the best time to plant a tree was 20 years ago, the next best time is today. Well, now is the time, coming off these last 3 years of really strong profits, when there's all this uncertainty about the macro economy and interest rates. It's easy to get paralyzed in sort of the chaos of it all. But we want to be very disciplined and strategic about how we're deploying our profits and our efforts moving forward. And now is the time to deploy that for the next 3 to 4 or 5 years. So be intentional, carve out time that's not focused on the crop budgets, it's not focused on marketing, not focused on getting our equipment ready for planting. That's all important, but how do we also carve out the time to say how and where do we want to see our operation change and grow in the future?
Thanks, David. David's right. It can be really difficult to carve out time for long-term strategic planning when we have so many immediate distractions and other operational tasks in front of us. But it's crucial to your farm's long-term economic health. Take, for example, farm succession planning. You may want your family's farm legacy to continue, but do you have an actual plan with agreed-upon goals and pen-to-paper details? If not, I'll remind you that Iowa Farm Bureau offers free farm succession planning workshops for its members through a program called Take Root. In fact, we have Take Root workshops coming up in Shelby, Tama, and Palo Alto counties in January and February. You can learn more about those workshops and sign up at iowafarmbureau.com/takeroot or by clicking the link in the notes for this podcast episode. Okay, up next we welcome Eldon McAfee, an attorney with an extensive history of providing helpful guidance to Iowa's livestock farmers. Eldon also keeps a close eye on the regulatory environment for livestock, and that was the subject of a discussion he recently had with Spokesman reporter Corey Munson on the heels of the recent Farming for the Future conference in Ankeny.
Eldon, thank you so much for joining me. I'd just love to go over a few of these issues specifically pertaining to rule changes coming out of Iowa DNR the last 12 months and going into 24. Can you tell me kind of how we got here? Why are these changes taking place?
Well, two things. One, about 2 years ago, maybe a little longer ago than that, there was a group of environmental organizations petitioned to DNR to adopt stricter regulations on livestock operations in the karst areas. Karst is a type of subsurface bedrock formations in northeast Iowa. They're a concern for groundwater percolation, potential contamination, but movement of groundwater. So that planted the start of, well, we're going to take a look at karst regulations. Then early 2022, DNR came out with a proposed rule, this bigger rule package that addressed several areas, but karst was in it. It was going to require a greater separation distance between the bottom of a manure storage structure, like a manure pit. Anyway, at that point, we worked on the rules that karst was kind of the center of it, but a lot of other parts of it were included. And DNR felt the need to restructure the chapter. It's Chapter 65. They felt that things got a little piecemeal, so they wanted to restructure. So it was kind of a complete rewrite. About a year ago, the Iowa's governor came out with Executive Order 10. This applied to all rules, all administrative rules by agencies. The Executive Order 10, one of the main requirements was we need to streamline those rules, eliminate duplication, eliminate references to the code, just try and streamline all that so the rules aren't quite so complicated or at least bulky. When that executive order came out, then this Chapter 65 rule, which was already down the track, so to speak, was put on hold. DNR went back to the drawing board using the requirements of Executive Order 10 and did more restructuring and more technical type changes. And the rule is now out for what we call public comment. It'll be published, and the comments will be either written or verbal at 2 meetings set up by DNR, but those are in February. So we have some time here for people to see the rule, and there have been several drafts of it, so people will be comparing this draft with the final draft, et cetera. But that's where we are right now.
Can you just kind of quickly run through, you mentioned karst. What are some of the other areas they focused on with the 22 rewrites?
Okay. From the substantive side, floodplains regulation has been changed to, I think, greatly simplified, where they will look at a siting atlas to determine if you're in the 100-year floodplain versus under the current rule, you have to do a declaratory ruling, and the DNR has to look at that rule on it. This will make it hopefully a lot more streamlined to use this siting atlas. We also talked about the rule proposes to change the process for the counties to adopt the master matrix. Currently, under the rule, each year during the month of January, each county has to affirmatively pass a resolution to use the master matrix for that next year when evaluating a construction permit application. DNR felt many counties have to do that every year and nothing changes. DNR is proposing that now a county that has adopted a resolution to use the master matrix for that next year doesn't have to do that every year. The adoption of it is in place until they decide to do otherwise. And then if you need to change your master matrix, and you get to choose what points you're going to take, which means you have to meet certain requirements. Well, some producers initially took points for composting mortalities, but have now decided I want to use rendering or something, just something different like that. They want to change it, and they want to change their points. Unfortunately, we don't have a way in the law right now to do that without getting a new permit. I believe there should be, but right now, unfortunately, the law doesn't allow for that. If you need a permit, you should have one, but if you don't need one, you shouldn't have to get one. And those are, right now, probably the major things in the rule that have, substantively anyway.
Then real quick here on our way out, you had mentioned the Iowa Environmental Self-Audit. It's kind of a mechanism for producers who may, and businesses who may discover violations or potential violations on their operation to report themselves to Iowa DNR and then not be penalized for that. Describe that a little bit more in detail and kind of how does that work?
This was put in the law in the late 90s, and it's not specific to livestock. It's for any DNR requirement, environmental requirement, that anyone who is subject to environmental requirements can do an audit of their own operation, business, whatever it is. For livestock producers, it'd be their livestock operation. If that's discovered by them through a self-audit, then they can file what's called a notice of self-audit with the DNR along with a voluntary disclosure of a violation, and there will be no penalties for, in effect, they have violated the law, but it doesn't apply if there's been any environmental contamination or anything. It applies to these types of things. If it's discovered by DNR in some type of inspection, there usually are penalties involved somewhere, $3,000 to $5,000, depending on what it is exactly. But if they discover that themselves or through their consultants, and then file the proper paperwork and then correct it, there will be no penalties.
It seems like that could be really useful.
DNR has been very supportive of this law, and DNR's position has been, without a law like this, that producer may not ever come forward and rely on not getting caught. As an attorney, I get the calls when people have problems with the rules and with maybe a DNR inspection or whatever. Keep in mind, these rules have changed as 95, 96, 2002, major legislative changes. Sometimes the requirements change, mainly related to construction. Sometimes DNR, they look at what the rules are today. That's their Chapter 65 manual they have with them. But maybe your operation was built in prior to 98 or even between 98 and 02. Just make sure if DNR believes you have a violation that they're not looking at the current rule that wasn't in effect when you built and you haven't expanded or changed your operation.
Thanks, Eldon. When it comes to regulation, there's always something to monitor, and that's why you have folks like Eldon and the attorneys here at Iowa Farm Bureau to keep their sights on important developments in the regulatory environment. It's also why you have the folks at the Coalition to Support Iowa's Farmers, an organization that's dedicated to helping livestock farmers reach their goals, implement best management practices, and comply with numerous regulations. They're a tremendous resource for farmers, offering free and confidential support. To learn more, you can visit supportfarmers.com or give them a call at 800-932-2436. Well, that just about wraps up this episode of the podcast. But before we go, we want to share 2 reminders with you ahead of your Christmas break. First is an important reminder of the many college scholarships available to our Farm Bureau members and their children, including renewable scholarships through the Iowa Farm Bureau that can be worth up to $10,000. Every year, between the state and county farm bureaus, we provide nearly $500,000 in scholarships to college students who are committed to having a positive impact on rural Iowa and agriculture. You can learn more about these scholarships at iowafarmbureau.com/scholarships or by clicking the link in the notes for this podcast episode. Our second reminder is an invitation to Iowa Farm Bureau's 2024 Young Farmer Conference, which is scheduled for February 2nd and 3rd in Altoona. This 2-day event is an excellent chance for young farmers and ag professionals from across Iowa to network, learn, and have fun. To learn more and register, please visit iowafarmbureau.com/YFC or click on the link in our episode notes. That's all for this episode of the Spokesman Speaks podcast. We hope you picked up some helpful information and that you'll join us for the next episode on New Year's Day. From all of us here at the Iowa Farm Bureau, we wish you and yours a Merry Christmas. Thank you for doing the work that inspires everything we do here at the Iowa Farm Bureau, and thanks for listening to the Spokesman Speaks.
Thank you for listening to the Spokesman Speaks, a podcast by Iowa Farm Bureau. Check out more podcast episodes at iowafarmbureau.com/podcast. You can also find and subscribe to the Spokesman Speaks podcast in the Apple Podcasts app, Google Podcasts, Spotify, iHeartRadio, and other popular podcast apps. We appreciate your ratings and reviews, and we welcome you to email us your feedback at podcast@ifbf.org.